they're going to destroy the dollar to keep the game going by supporting the bond market. They got the front end covered. If Judy's right, they got the back end covered. Who loses? Every one of us who holds our wealth in dollars. The dollar's lost 97% of its purchasing power over the last 112 years. And if you look at Section 2A of the Federal Reserve mandate, it's funny. It says it requires currency stability. That's right. And so anyways, the bottom line is he's right. And if you save in gold, everything is affordable and cheap. You save in dollars, you're gonna go broke.
In today's news recap, Switzerland is in crisis mode as it tries to avoid a 39% tariff imposed by the U.S. The government held emergency talks to draft a plan, and Finance Minister Karen Keller-Sutter is willing to travel to Washington if a solution is in sight. The U.S. cited a trade deficit of $38 billion as the reason for the tariff, which Switzerland disputes as absurd. The Swiss have limited options, but one possible solution is offering to purchase liquefied gas from the U.S. Switzerland is in crisis mode as it grapples with a 39% tariff imposed by the United States. The government has convened emergency talks to draft a response, with Finance Minister Karen Keller-Sutter ready to travel to Washington if a solution emerges. The tariff, set to take effect on August 7th, is one of the highest globally, threatening Switzerland's export-oriented economy. The tariff was imposed despite months of negotiations, with the Swiss government expressing great regret over the new rate, which differs significantly from the draft framework they were negotiating. The Swiss economy, heavily reliant on exports to the U.S., faces significant challenges, with pharmaceuticals and luxury goods particularly at risk. Swiss officials dispute the U.S. claim that a trade deficit of $38.5 billion justifies the tariff, describing it as absurd. The Swiss government has limited options, but one potential solution is to offer to purchase liquefied natural gas from the U.S., a move that could help reduce the trade deficit. The Swiss government plans to revise its offer and hopes to achieve a better deal by the deadline. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. More importantly, check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and multiply your ounces without taking any fiat risk. Let's get back into the episode.
So margin debt is the total amount of money that an investor would borrow from their brokerage to buy stocks. So if you put in $10,000 of your own money, you can borrow another $10,000 from your broker, and now you control $20,000 worth of stock, but half of that is debt. And there's a certain level where if it goes below that, you have to come up with a margin call to keep that from. It's a speculation. It usually, the higher the margin debt, generally the more leveraged and dangerous the market is. Margin debt just hit $1.008 trillion, the highest level in history. That's more leverage than at the peak of the dot-com bubble or the 2008 crash. It's the most dangerous signal in the markets right now. And remember what we were saying last week? Ma and Pa have virtually no exposure to commodities as the world's commodity exchanges are being bled dry month over month. The largest deliveries ever. 6 billion in the first 3 days of this month, 8 billion in May, the largest silver delivery ever in May, the largest gold delivery ever in May, and on. Every month we're seeing this, and the public has virtually none. On the other end, the insiders are dumping stocks at record levels. What's his name? From Jeff Bezos, $6 billion worth of stock since June he's sold. Look at Jamie Dimon, look at Warren Buffett, look at Zuckerberg. They're all dumping. The institutionals, the big traders, have been averaging $2 billion a week since June of sales. They're all leaving the equity market, and you have the largest amount of margin debt ever and the largest allocation to stocks by the retail public in an all-time. What could possibly go wrong? The insiders are going heavy in commodities and dumping stocks as the public has nothing in the way of commodities and is the deepest in not only the stocks, but also margin debt of all time. It's a very, very bad thing. And if you're a conspiratorialist or realize that the line between conspiracy and reality has grown thinner and thinner and thinner, or you just realize that the big money, like the little man rule, is always moving when the other group has no idea. And this is how it always goes. So should we expect, August is typically the worst month of the year for stocks. September is usually a bad one too. But should we expect something? Remember what happens in October. We're at the part of the year where it's typically very
Choppy.
tenuous. Yeah, choppy. So, but at the same time, the biggest money in the world is jumping into gold and silver, and no one knows it. No one understands it. No one sees it. It's a big deal, done again. And whether you're talking unemployment, inflation, everything is pointing towards craziness coming up. And to me, the real demand for physical metal on COMEX underscores everything, because that's never happened before. When you see every contract stopped, every single one that was posted went to delivery instead of settling in cash. I mean, these are things you never see, ever. And it's continuing. So I guess only time will tell where this all ends up. But even like our allies are pushing back. You know, India is being threatened if they continue to buy oil from Russia with another tariff from Trump. Well, India said we're not going to stop buying oil from Russia. So, you know, at what point does it piss off our allies so much we keep poking them, where they say, you know what, I'm glad I've set up an infrastructure with these guys. And at what point does Saudi Arabia, who is a full member of the bridge technology and involved in all of these meetings and setting up a Shanghai Metals Exchange in their country, what point did they say, we're done? I mean, this is the little by little. Are they waiting out Trump? I don't know. But you can see this, and we're even aggravating Mexico and Canada and all of these countries that have been on our side. We're putting tariffs on all of the European countries that were supposedly our allies. Maybe they really are trying. I think they are trying to lose the reserve status. They understand it's hollowed out our manufacturing. There's no way back unless we stop being the reserve status, but focus on the legitimacy of our treasury market. That's more important. And I think it's a soft default on the dollar and the lesser of two evils. And everything I'm seeing, whether it be Trump's actions, the market's actions, the gold inflows, the central bank purchases, the repatriations, everything is pointing to this. Everything. So yeah, it's, I think the worst possible place you can be right now is really, truly is a large dollar holding. And we haven't even talked for a while about the banks. We don't need to today, but you know, keeping your money in a banking system where if things go haywire, you're an unsecured general creditor in a currency that's lost 11% this year, and just accelerating the trend that we've seen since forever, since the Fed came up, and since 71, we've lost 90%. I don't know. I just think it's time to realize that we're there. We are there right now. With this new stablecoin bill, you could argue it is a new monetary system that is happening, going from synthetic demand, from organic demand to synthetic demand, and that's where it all starts. So loss of confidence, loss of trust, loss of value. Now's the time.
In today's news recap, Citi raises gold forecast to $3,500 per ounce over the next 3 months on negative U.S. outlook. Citi raised its gold price forecast over next 3 months to $3,500 per ounce on Monday from $3,300, and the expected trading range to $3,300 to $3,600 from $3,100 to $3,500 on the belief that near-term U.S. growth and inflation outlook has deteriorated. U.S. growth and tariff-related inflation concerns are set to remain elevated during the second half of 2025, which alongside a weaker dollar are set to drive gold moderately higher to new all-time highs, the bank said. Last week, U.S. President Donald Trump imposed steep tariffs on exports from dozens of trading partners, including Canada, Brazil, India, and Taiwan. The tariffs imposed last week on scores of countries are likely to stay in place rather than be cut as part of continuing negotiations. Trade Representative Jamieson Greer said on CBS show Face the Nation, aired on Sunday. Last week, the dollar weakened after non-farm payrolls increasing by 73,000 jobs last month, after rising by a downwardly revised 14,000 in June, which revived hopes of a Fed rate cut in September, with markets now pricing in an 81% chance. Per CME FedWatch tool Citi also highlights weaker U.S. labor data in second quarter of 2025. Institutional credibility concerns have increased regarding the Federal Reserve and U.S. statistics and elevated geopolitical risks related to the Russia-Ukraine conflict. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Anything that comes out of the Bureau of Labor Statistics is a bunch of BS. It should not be BLS, it should be BS. Everything they've talked about, everything that they do talk about, the CPI data as an example, if true inflation was reported the way that it is, there's no way anyone would buy long-term treasury bond at 4 or 5%. However, you tell everyone and convince them that inflation's just 2%, then, a 3% inflation-adjusted return doesn't look so horrible, does it? No, it doesn't. But it's just one big lie after another. It's a scam. So on Friday, June 6th, the BLS reported 144,000 new jobs. In May, stocks rallied. Gold price fell by $28. On July 3rd, the BLS reported the U.S. had added 147,000 new jobs. In June, stocks rallied. Gold price fell by $17 a night. Craig Hemke, I think, wrote this. Thank you, Craig. So they revised the non-farm payroll numbers, and you wonder how the markets would have reacted if these numbers had been up to date at the time. They revised the 144,000 that we had in May to 19,000, and June's from 147,000 to 14,000. Out of 258,000 jobs. I mean, you can't even make it up. So, they say 73,000 payrolls increasing by 73,000 less than had been forecast. So okay, great. But then we find, so it's bad, the numbers that just came out, the jobless rate rose to 4.2%, 73,000 less, but they lopped off 258,000 jobs from the last two numbers. And taken together, those numbers completely change the trajectory of recent trends. So the average 3-month payroll gain went from 150,000 before Friday's release to just 35,000. And so, I mean, I don't even know how this cannot be. And then it gets weirder, of course. So the woman announcing this, her name was Erica McAntifer. And the only reason I know that is because Trump fired her later in the day, claiming political bias on the BLS data. Now, that's silly, President Trump, with all due respect. That's silly because, it's like not counting 100 million working age people who don't have a job in our unemployment numbers because they fall off. Well, how about that? How about all of the stuff that we do, not including food, energy, and housing in the CPI, not putting taxes in the CPI for all of us working? It's our biggest expense. So, look, I just think it's interesting when us tinfoil hat wearing people talk about conspiracies and all this stuff, and I say BS instead of BLS. How much more in your face do you have to know? This is what we saw during the previous administration, and I'm sad to see now we're seeing it here too. It's like they're guessing. And then when they come back and revise it, how many people notice it? Not many. It's the biggest revision in history ever, but it should be bigger news than it really was. And while we're talking these kind of things like the Fed and whatnot, looks like someone named Kugler will step down August 8th. Kugler, a former chief economist at the Labor Department, was appointed by Biden in 2023. And Kugler now stepped down as one of the members of the Fed governor board. So that gives Trump room to put someone in now before Powell's tenure is up. So things are going to start to get interesting real fast with whoever fills that spot before someone fills the governor spot.
What do you think of Schectman's take? Do you agree with him? Is the big reset a reality, or is it all just bollocks? Post in the comments section down below your honest opinion and share with the stackers your gold and silver price prediction. Now, check this video right here because it's a perfect fit for you, and I'll see you on the other side.